Hi, and welcome back to our ongoing series entitled Retail Store Innovative Management Training. Someone asked me yesterday, how long will we continue to present this series? And my answer was, we will not rest until every retail operator in the world gets the message and understands what we have learned over the past 42 years. Then maybe we will change the subject. In this video, we are going to talk about carrying cost and how they secretly steal your profits. Like high blood pressure, diabetes, cancer, and high cholesterol, carrying costs can be a silent killer of convenience stores. And as in the case of the diseases I mentioned, they are largely ignored until it's too late to do anything about it. The definition of carrying cost is the costs that are difficult to track and are calculated using the average cost value of the inventory carried in your stores over the course of your fiscal year. Carrying cost is the cost for the storing and holding of inventory before it is sold to the customer. The elements that make up carrying cost include the cost of the money tied up in inventory, storage fees, taxes, insurance, employee cost, and opportunity cost. Opportunity cost are what the retailer sacrifices when choosing one option over another. As an example, Overstock accumulated for a pending sale or promotion, or choosing one brand over another to get a deal that may result in less than the profit that would have been earned because of the loss of sales from a more profitable item, often referred to as cannibalization. Carrying costs are extremely difficult to follow because, for the most part, they are invisible in day-to-day operations. However, they can have a significant impact on whether a store operator is successful or not. Businesses must consider these costs to evaluate the level of profit they can reasonably expect to earn from their current inventory. By knowing your carrying cost, a business can stay on top of expenses and continue to generate a steady income stream. To calculate a more accurate carrying cost for one of my customers operating 42 stores, I began by calculating the average cost value of their inventory at the end of 2019 as being 73% of retail, or $109,340 per each store. In a category management environment where the purchase cost of individual items are lost at the time the items are received, retailers are forced to calculate an average cost value as a percentage of the retail value in all categories, and apply that percentage to the retail value of the stock in the stores after an audit. This is just one more reason I have found that using category management as a method of tracking the retail value of inventory can vary by as much as 25% more or less. Most retailers assume their cost of sales to be closer to 70%, but this is because they completely ignore carrying cost in their calculations. In this customer's case, assuming that my estimate of the cost value for each store as being $109,304 is correct, 25% of that figure makes up the carrying cost of each one of the 42 stores mentioned. Therefore, the average carrying cost of each store came to $109,304 times 25%, which equals to $27,326 per store. At the end of the company's fiscal year, accountants will use this figure and apply it to all stores to arrive at a more accurate representation of store profits. The major contributor to carrying cost is Overstock, and Overstock is the father of out-of-stocks. So paying attention to carrying cost can make a huge difference in whether you are successful or not. We will discuss this in greater length as we continue on with our courses. Thank you for watching our ongoing Retail Store Innovative Management Training series. to reach out to one of our associates or mentors. You may write to storereportinfo@gmail.com, and someone will respond as time allows. And be sure to click on the subscribe button below and the little bell next to it if you would like a heads up when we post new videos. I appreciate it and hope to see you next time.